Imagine having a personal trading assistant, one that, never sleeps, never gets emotional, and can process market data way faster than any human. We're diving deep into algorithmic trading today, and we're specifically zooming in on crypto trading bots. Yeah, this deep dive is really all about pulling back the curtain on these automated systems. We want to explore how they actually work, the tools and strategies they use, some are pretty cutting edge, and really what it takes to make them work in the crypto world, which is, let's face it, incredibly volatile. And we've got a great stack of sources for you, some academic papers, industry guides, but also, interestingly, a Reddit thread with some real-world, boots-on-the-ground experience. Our mission here is to pull out the most important bits, maybe some surprising facts. The critical insights basically give you a shortcut so you're well-informed on this field, because it's moving fast. So, okay, let's unpack this first. When we say algorithmic trading, what exactly is that?
Right. So at its heart, algorithmic trading is basically using computer programs' algorithms to automate your trading decisions. These programs analyze market data, they spot opportunities based on rules you've set beforehand, and then they go ahead and execute the trades, all without a human needing to click the button. Think of it exactly like that tireless personal trading assistant you mentioned.
Okay, and how different is that really from the traditional way, manual trading?
Oh, it's a massive shift, a complete paradigm shift, really. Yeah. Manual trading, that relies on, human analysis, gut feeling, intuition, and often emotion gets in the way, right? Fear, greed.
Yeah, definitely.
Algorithmic trading, though, it's purely quantitative, numbers and rules. And this means trades can happen at the absolute optimal times and prices. It often lets you grab these tiny market inefficiencies a human would just completely miss.
Like what kind of inefficiency?
Well, the classic example is arbitrage. Say, Bitcoin is a fraction cheaper on exchange A than on exchange B. An algorithm can spot that, buy on A, sell on B, almost simultaneously. We're talking milliseconds. A human just can't physically do that.
Right, that speed advantage is huge. But, okay, beyond just being fast, what are the other big benefits? Why are these bots seen as such a game changer, especially for crypto?
Well, the speed and efficiency, definitely number one. Like we said, analyzing tons of data, executing trades super fast, that's critical when markets jump around like crypto markets do. A tiny delay can cost you. But then there's the 24/7 operation. Crypto never sleeps, right?
Never.
So bots can work around the clock, across all time zones. You don't miss opportunities just because you're asleep.
True, but doesn't that also mean your bot is always exposed to risk?
Exactly. It's a double-edged sword. That constant operation is great for catching opportunities, but it absolutely demands really solid risk management built in. You can't just set it and forget it entirely. Another huge plus, maybe the biggest for some people, is emotion-free trading.
Taking the fear and greed out of it.
Precisely. Bots stick to the logic, the data. No panic selling, no FOMO buying, just disciplined execution based on the rules. That's a massive edge.
I can see that.
And then there's customizability. You can program these things with incredibly specific strategies, tailored exactly to what you want to achieve. Are you trying to scalp tiny profits hundreds of times a day? Or are you building a long-term position? You can build a bot for that.
Okay.
And finally, accessibility has gotten way better. Platforms now offer pre-built bots, templates. It's easier for people who aren't, hardcore programmers to get started and experiment. So yeah, when we talk about the brains behind these bots, we're talking about the trading algorithms themselves. And at their core, they're just a set of rules, instructions for the computer. Read this data, look for this pattern if you see it, execute this trade. They can be super simple or incredibly complex.
Okay, that makes sense. It's the logic engine. So if the bot is working tirelessly and without emotion, what kind of logic, what strategies are actually running inside? Can you give us an example of a really common fundamental one?
Absolutely. A real cornerstone strategy is the moving average crossover. Super common. It calculates the average price of an asset over a specific period. Now, in crypto, that period might be much shorter than in traditional markets. Instead of a 50-day average, you might use, say, a 1.7-day average based on price data from every 5 minutes. Much more responsive to quick crypto moves.
Okay, a shorter time frame average.
Yeah.
And how does it know when to trade based on that?
The signal's pretty straightforward. If the current price crosses above that moving average line, that's generally seen as a buy signal. The thinking is momentum is shifting upwards.
Right.
Conversely, if the price drops below the moving average, that's your sell signal. It suggests the trend is turning down. The idea is to get out, maybe hold stable coins or USD, and avoid bigger losses if the price keeps falling.
So it helps you kind of sidestep the big dips?
Exactly. Our sources had an example with Litecoin back in early 2018. When its price crossed below that 1.7-day average, a bot using this strategy would have sold. And as Litecoin's price continued to drop, the bot's capital would have been preserved in USD, meaning it outperformed just buying and holding through that crash.
Interesting.
And there's a refinement called the exponential moving average crossover, or EMA. It just gives more weight to the most recent prices, making it react even faster to current market changes.
Okay, so that's one core strategy. What else is common?
Another big one is mean reversion. This also uses a moving average, but it adds these upper and lower bands around it. Maybe, say, 3% above and 3% below the average line.
Okay, bands. What's the idea there?
The core idea is that prices, even for volatile things like crypto, tend to fluctuate but often snap back towards their average, their mean, eventually.
Like stretching a rubber band and letting it go.
Sort of, yeah. It assumes that when the price moves too far away from the average hitting the upper or lower band, it's likely to correct back towards the center.
So it's trying to predict those little reversals faster than just waiting for the price to cross the average line itself.
Exactly. Catching those potential turning points sooner. On smaller time frames, you definitely see this kind of reversion behavior, even in crypto.
Okay, interesting. What else?
Then you've got pairs trading. Now, this one's quite different. Instead of trading, say, Bitcoin against the US dollar, pairs trading looks at two different cryptocurrencies.
Two cryptos against each other.
Yeah. It tries to profit when one crypto in the pair goes up relative to the other one going down, or vice versa. It often uses mean reversion logic, but it applies it to the difference or the ratio of the prices between the two coins.
Huh. That's fascinating because it sounds like it could potentially make money even if the whole market is just going sideways or even if one of the coins is actually losing value overall.
Precisely the goal. You're looking for pairs that are historically quintegrated.
Quintegrated, meaning?
Meaning they tend to move together over the long run, even if they diverge temporarily. Like, maybe Ethereum and a specific DeFi token tend to track each other. If suddenly Ethereum shoots up way more than the token, the bot might bet that the gap will close. It might short Ether and go long on the token, expecting their usual relationship to reassert itself.
Wow, okay. That sounds more complex.
It can be, but the beauty is if you focus on, say, the top 5 or 10 cryptos, the number of possible pairs isn't overwhelming. You have maybe 10 pairs from the top 5. You can actually test those relationships directly without needing super complex statistical tests right off the bat.
Gotcha. So moving averages, mean reversion, pairs trading, any other major strategies we should know about?
Yeah, definitely a few others are very common. Arbitrage, which we touched on, exploiting those tiny price differences across exchanges.
Yep.
Super speed dependent. Market making is another. That's where a bot places both buy orders, bids just below the current price, and sell orders, asks just above.
Try to capture the spread.
Exactly. They profit from the bid-ask spread, the small difference between the highest buy price and the lowest sell price. And in doing so, they actually provide liquidity to the market, which is helpful.
Okay.
And then there's trend following. This is maybe the most intuitive. The bot identifies an established trend upwards or downwards and just jumps on board. Buys when things are clearly going up, sells or shorts when things are clearly going down, assuming the trend will continue for a while.
Right. Ride the wave. Okay, this is fascinating. Now, for someone thinking, okay, I want to build one, or even just understand the tech better, this is where it gets really interesting, right? The tools. What programming languages are people actually using to build these bots?
Yeah, the toolkit is key. And the choice of language really hinges on what you're trying to do, what your trading goals are. But the big one, the absolute go-to, especially for developing and testing strategies, is Python.
Python? Why Python?
It's relatively easy to learn. It's readable. But crucially, it has this incredible ecosystem of libraries specifically for data analysis and finance. You've got pandas for handling data, NumPy for math stuff, scikit-learn if you want to get into machine learning, TALib for all sorts of technical trading indicators.
Yeah.
It makes prototyping and backtesting strategies much, much faster. More than half the developers in this space use Python for analysis.
Okay, Python's the workhorse for development. What about for pure speed? If you need that microsecond advantage for arbitrage or high-frequency trading.
Then you're looking at C++. It's lower level, gives you more direct control over the hardware, and it's just faster. When absolute minimum latency is the name of the game, C++ is often the choice.
Got it. Any others?
Java is also a major player, especially in the established financial world. Something like 85% of e-banking and trading systems run on Java. It's known for being robust, reliable, good for large, complex systems, and handles multi-threading well. And R is worth mentioning, too. It's really strong for pure statistical analysis and visualizing market data, especially time series stuff and risk modeling.
So different tools for different jobs.
Exactly. And often sophisticated systems use a mix, what they call a hybrid approach. Maybe they'll prototype and research strategies in Python. Yes, it's fast for development.
Right.
But the core engine that actually executes the trades might be written in C++ for maximum speed and performance. Best of both worlds.
That makes a lot of sense.
Mm-hmm.
Okay, diving specifically into Python then, since it's so popular, are there particular libraries that someone interested in this should really know about?
Oh, yeah, definitely. Beyond the basics like pandas and NumPy, there are some fantastic specialized libraries. FinTA, for instance, is great. It implements something like 80 different technical trading indicators, and it's designed to work smoothly with pandas data frames. Feed it data, get your indicators out. Simple.
Nice.
Then there's Zipline. This one's a bit more general purpose. It's really popular, got almost 13,000 stars on GitHub. It's a full framework for writing complex strategies and, crucially, backtesting them thoroughly. It actually powered Quantopian, which was a big online community for quantitative finance folks.
Wow. Okay. Sounds powerful.
For crypto specifically, CCXT, that stands for Cryptocurrency Exchange Trading Library, is an absolute lifesaver.
Why is that?
Because every crypto exchange has its own slightly different way of doing things, its own API, application programming interface. It's a nightmare to code for each one individually. CCXT basically creates a universal translator. It supports over 120 different exchanges through one consistent interface. You write your code once using CCXT, and it handles talking to Binance, Kraken, Coinbase, whoever. Huge time saver.
That sounds invaluable. Seriously.
It really is. Another good crypto one is Freaktrade. Also supports lots of exchanges, has built-in backtesting, plotting tools. You can plug in machine learning models. And it has this neat feature where you can control it using Telegram messages. Like you can send your bot status or profit and get updates.
Huh. That's cool. Manage your bot from your phone.
Yeah. For getting market data, YFinance is a reliable way to pull historical data from Yahoo Finance. And Backtrader is another very popular Python framework for backtesting and live trading, known for having a really active community supporting it.
Okay. Lots of options there. Any more cutting-edge ones?
Yeah, if you're looking towards AI, TensorTrade is interesting. It's a framework specifically for building trading bots that use deep reinforcement learning. It's still technically in beta, but it's definitely gaining traction.
Reinforcement learning, like teaching the bot through trial and error.
Exactly. Rewarding it for good trades, penalizing bad ones, letting it figure out strategies on its own. And then there's that really surprising one, Trump 2 Cash.
Right. You mentioned that. Tell me more.
It's just fascinating because it highlights using totally unconventional data. It monitors Donald Trump's Twitter feed. When he tweeted about a publicly traded company, the algorithm would analyze the sentiment of the tweet, was it positive or negative? And then it would execute trades based on that sentiment, betting the stock price would react accordingly.
And it actually worked.
Apparently, it was surprisingly successful. And the key takeaway isn't just about Trump, but the concept. The source code is available, and you could adapt that idea to monitor, say, influential crypto accounts, project announcements, news feeds, analyze the sentiment, and trade based on that social signal.
Wow, sentiment analysis driving trades automatically. That's wild.
It really opens up possibilities. And connecting this back to understanding the market in real time, another absolutely critical data source for many bots is the order book.
The order book. Okay, why is that so crucial? What exactly are we looking at there?
Think of the order book as a live digital list right on the exchange, showing every single buy order and sell order currently open for a specific trading pair, like Bitcoin versus the dollar.
So all the people waiting to buy and sell right now.
Exactly. And it gives you incredibly valuable insights into market depth.
Market depth meaning how much is available to trade?
Yeah, basically how much buying and selling interest there is at each specific price level near the current price. It shows you the volume of orders stacked up. It helps you understand how much you could potentially buy or sell without significantly moving the price yourself.
Okay, and what are the key parts of it?
You've got the bids. Those are the buy orders listed with the highest price someone is willing to pay at the top. And the asks, the sell orders, with the lowest price someone is willing to sell at the top. The difference between that highest bid and lowest ask is the famous bid-ask spread. The market depth itself is seeing the volume of those bids and asks at each price level going down the book. And this all ties into liquidity. How easily can you trade this asset right now without messing up the price? A deep order book means high liquidity.
And why is seeing all this so important for a trading bot?
Because it's a real-time pulse of market sentiment and supply demand. For example, if you see a massive wall of buy orders stacked up at a certain price level, that can act as a strong support level. The price might bounce off it because there's so much buying interest there. Conversely, a huge sell wall can act as resistance.
So bots can use these walls to predict potential price bounces or stalls.
Yes, exactly. They can also spot liquidity gaps areas with very few orders, which might signal that if the price reaches that zone, it could move through it very quickly, leading to volatility.
Makes sense. What kind of strategies heavily rely on order book data?
Scalping definitely does. Those high-frequency strategies making tiny profits rely on reading the immediate order flow and spread. Support and resistance trading, like we just discussed, identifying those walls. And interestingly, even detecting spoofing.
Spoofing, like fake orders.
Yeah, it's illegal in regulated markets, but you might see it in crypto sometimes. Someone places a huge buy or sell order they never intend to fill, just to create a false impression of demand or supply, hoping to nudge the price. Sophisticated bots can sometimes identify patterns indicative of spoofing by analyzing the order book dynamics.
Wow. And how do bots get access to this order book data?
Most exchanges provide it directly through their built-in trading interfaces. There are also aggregated data providers like CryptoWatch or CoinAPI that gather data from multiple exchanges. Trading platforms like TradingView often have great visualization tools like liquidity heat maps based on order book data. And of course, for serious bot developers, exchanges offer APIs to stream this data directly into their algorithms for analysis.
Okay, so we've got strategies, languages, libraries, data sources like order books. How does someone actually put all this together and create a crypto trading bot? Seems daunting.
It definitely requires a mix of skills, technical know-how, a good plan, and some resources. But it's doable. First step, absolutely critical. Define your objectives. What exactly do you want this bot to do? Are you scalping? Arbitraging between exchanges? Building a long-term portfolio based on trends? Be crystal clear on the strategy.
Okay, know your goal. Then what?
Then choose your programming language. As we discussed, Python's often a strong starting point because of its libraries and ease of use. Next, you need to select a trading platform or exchange. You need one with a reliable API that your bot can connect to. Kraken, Binance, Coinbase Pro, many offer robust APIs.
Right, the connection to the market.
Then comes the core development work, building the bot's features. This means coding, how it assesses market data, how it generates the actual trading signals, maybe using those moving averages we talked about, or maybe something more complex like machine learning, how it executes the orders through the exchange's API, and crucially implementing risk controls. Stop losses, take profit targets, position sizing rules. You absolutely need those safety nets.
Risk management seems non-negotiable.
Absolutely non-negotiable. And for more advanced bots, you might integrate AI. AI can help the bot learn from how the market changes, maybe predict price movements by analyzing huge data sets, or fine-tune its own strategy over time. This could involve deep learning models or even natural language processing to analyze news or social media sentiment, like we discussed.
Okay. And then you need somewhere to hold the crypto, right?
Yes, essential. You need to implement a secure crypto wallet system for holding the assets the bot is trading and ensuring transactions are handled securely. And once you've built this thing, the next stage is absolutely vital.
Testing.
Testing, testing, testing.
You cannot skip this. You have to make sure the bot actually works the way you designed it, especially under different kinds of market conditions, before you let it touch real money. So what does that testing process look like for someone starting out? Is just running it on old data backtesting good enough?
Backtesting is the essential first step, yes. You feed the bot historical market data and see how your strategy would have performed in the past. Did it make money? How much risk did it take?
Okay.
After backtesting looks promising, the next step is usually live testing or paper trading. You run the bot in the current market, but using fake money or on a dedicated testnet environment provided by the exchange.
So it's reacting to real-time prices, but no real money is involved yet.
Exactly. It lets you see how it handles live data feeds, latency, actual market dynamics without risking capital.
But you mentioned earlier that even backtesting has flaws. Something about the community raising questions.
Right. This is a really important point, often brought up by experienced traders. Backtesting is super valuable, but it's often flawed. Why? Because the historical data might not be perfectly granular. It might not capture every single tick or the state of the order book exactly as it was. Your backtest might assume your order fills instantly at the recorded price.
which might not happen in reality.
Precisely. It can't perfectly replicate the slippage you get in live trading or the exact impact of your own orders on the market price, especially if you're trading significant size. It can't fully look inside the candle of historical data.
So the real world can be messier than the simulation.
Much messier. That's why many experienced folks emphasize forward testing, running the bot live, even if it's with a very, very small amount of real money. There's just no substitute for seeing how it performs with actual skin in the game, dealing with real latency, real fills, real fees. That's where the true learning happens.
Okay, that makes sense. Put a little bit on the line to really see. And when you're evaluating back testing or forward testing, what metrics are you looking at besides just profit?
Good question. Profit or return on investment, ROI, is obviously key, but you need to look deeper. The Sharpe ratio is critical. It measures your return relative to the risk you took. A high Sharpe ratio means you're getting good returns for the level of volatility or risk exposure.
Better risk-adjusted returns.
Exactly. You also look at the win-loss ratio, how many trades were profitable versus unprofitable, the profit factor, gross profits divided by gross losses, and specific risk metrics. Things like value at risk, VAR, which estimates your potential maximum loss over a certain period, and maximum drawdown.
Maximum drawdown.
That's the biggest drop your account value experienced from a peak to a subsequent low. It tells you the worst run of losses the strategy endured. You need to know if you can stomach that kind of drawdown.
Right, understanding the worst-case scenario.
Yeah.
Now, you mentioned a Reddit thread with insights from an experienced trader. What were some of the hard truths shared there? The real-world perspective.
Yeah, this was super valuable. This person had over 10 years of manual trading experience and then 4 years running their own algos.
Yeah.
Some really stark points came out. First, echoing what we've said, it's not a magic bullet. Don't expect to turn on a bot and print money guaranteed. Most consistently running algos they found actually make relatively small, steady profits, not lottery wins. That really counters the hype you see online.
Okay, manage expectations. What else?
Second, costs are killers. This is huge. Transaction fees charged by the exchange, slippage getting a worse price than you expected when your order fills, and the bid-ask spread. These things can absolutely kill your backtest results when you go live. A strategy that looked great on paper can become unprofitable once real-world costs are factored in.
So minimizing those costs is crucial.
Absolutely critical. And related to that is lowering latency, especially for faster strategies. They recommended keeping latency under 10 seconds for short-term trades if possible.
Wow, okay. That really drives home the difference between theory and practice. What was the biggest killer they highlighted for newcomers?
Slippage and fees seem to be the silent assassins. Backtests often assume perfect execution, which just doesn't happen. The pros fight this by picking exchanges with deep liquidity and low fees, using smarter order types like limit orders instead of just market orders, and constantly refining the bot's logic to execute trades gently without moving the market too much against itself.
Makes sense. Any other key takeaways from that real-world experience?
Yes, several more. One was continuous monitoring. Algos are absolutely never set and forget. They found it requires daily checks, daily operational tasks. It's not passive income in that sense.
Not just turning it on and walking away.
Definitely not. Also, market adaptability is key. Markets change character. Sometimes they trend strongly. Sometimes they chop sideways. Sometimes they're wildly volatile. You need to be able to identify the current market type for your bot's time frame and be ready to switch strategies or turn the bot off if conditions aren't right for its logic.
Because the bot needs different modes, or you need different bots.
Potentially, yes. Or just the discipline to know when your current bot strategy is unlikely to work. Interestingly, though, they did find their algos generally performed better than their own manual trading.
Why was that?
Primarily because the algos eliminated the emotional mistakes, especially on the exit side, cutting losses or taking profits consistently based on rules, not fear or hope.
The discipline factor again.
Exactly. But another sobering point was lifespan. They found that even a successful algorithm tends to only work well for maybe a couple of months before the market adapts or its edge gets competed away.
Only a couple of months?
Right.
Wow. So you constantly need to be researching and developing new strategies.
That seems to be the reality for sustained success. It requires continuous refinement, tweaking, and looking for new inefficiencies.
Okay. That sounds like a lot of work, but was there any good news for someone starting out?
Yes, definitely. They emphasize that starting small is very achievable. You don't need a huge bankroll. You can realistically build and test your own system with low starting costs, maybe even just $100 to get your feet wet with live microtrading.
Okay, so the barrier to entry isn't necessarily massive capital.
Right. And they also mentioned the hybrid approach. Some traders don't fully automate everything. They use their algorithms more as sophisticated indicators for manual trading. The bot might signal a potential entry or exit based on complex analysis, but the human makes the final decision, blending the strengths of both.
Interesting. Automation assists the human rather than replaces them entirely.
Yeah, it's a valid approach. And tying this back to the technology, AI is playing an increasingly large role here, making these systems even more adaptive. AI can process just unbelievable amounts of data news, social media, market data, order books way faster than humans, potentially spotting patterns or shifts we'd miss. It can analyze that social media sentiment we talked about.
Right, the Trump to cash idea, but broader.
Exactly. Gauge the market mood in real time and perhaps adjust the bot's aggressiveness or strategy accordingly. This leads into AI-driven risk management.
How does AI help with risk specifically?
It can allow for much more dynamic risk control. Instead of just a fixed stop loss, an AI might continuously assess risk factors, market volatility suddenly spiking, liquidity drying up, and adjust the bot's position size, or tighten stop losses, or even hedge the position automatically in response. It might use predictive models for volatility, analyze sentiment shifts, and trigger automated responses based on predefined but dynamically adjusted thresholds.
So smarter, more adaptive safety nets.
That's the goal. And some sources draw parallels to control systems integration from engineering, applying concepts like feedback loops. The system makes a trade, observes the market reaction and the outcome, and uses that feedback to learn and refine its decision-making process for the next time, continuously self-improving, managing risk, and even potentially helping with regulatory compliance checks.
Okay, that brings us towards the future then. Looking ahead, with AI getting better, markets staying volatile, what does the horizon look like for algorithmic trading in crypto?
Well, you hit the key points. We can absolutely expect continued rapid advancements in AI and machine learning within trading. Algorithms will likely become even more autonomous, capable of learning, adapting, maybe even discovering novel strategies with less and less direct human guidance.
So self-sufficient bots.
Plausibly, yes. And then there's the really far out but fascinating prospect of quantum computing, if or when that becomes practical. It could just shatter current limitations on processing speed and complexity. The kinds of analysis and prediction that might become possible are hard to even imagine right now. That could completely revolutionize algorithmic trading.
Quantum trading bots.
Yeah.
Wow.
Yeah.
Okay. And is this AI-driven approach something that will stay just in crypto, or will it spread?
Oh, it's definitely not just crypto. These techniques, AI for prediction, adaptive risk management, control systems, have huge potential across all financial markets: equities, forex, commodities, bonds. Anywhere there's data and electronic trading, these more sophisticated algorithmic approaches are likely to become more prevalent.
A broader trend in finance. And what about the rules, the regulations? Crypto is known for being a bit Wild West sometimes.
That's a critical piece. The regulatory landscape, especially for crypto, is definitely still evolving, and it varies a lot by country. Staying compliant is crucial. That means keeping up with changing regulations, using reputable, licensed exchanges that adhere to compliance standards. And as AI becomes more deeply integrated, it raises new regulatory questions, too, about transparency. How does the AI make decisions? Accountability. Who's responsible if an AI goes rogue? And ensuring fair market practices. We'll need robust frameworks to address those ethical and practical challenges.
Yeah, the rules need to catch up with the tech. Okay, this has been a really deep dive. We've gone from the basics of what algorithmic trading is, through common strategies like moving averages and pairs trading. We looked at the toolkit Python, C++, Back, specialized libraries like CCXT and Free Trade, explored the importance of order books, the process of building and testing bots, and importantly, heard those real-world challenges about costs, monitoring, and the limited lifespan strategies.
Yeah, and we saw how AI is really changing the game, not just for finding opportunities, but critically for managing risk in a much more dynamic way, plus those future trends like quantum computing and the regulatory questions.
It really feels like we've covered a lot of ground. So thinking about all this, the speed, the data, the AI, the 24/7 nature of crypto, here's a final thought to leave our listeners with. As this collaboration between human ingenuity and artificial intelligence gets deeper in the trading space, what kinds of strategies or market efficiencies, things we might not even be able to imagine today, could emerge? Something to ponder as you continue your own learning journey in this fascinating area.